welcome everybody. Yeah, good to see everybody. Welcome as we head into May here. Arlen and everybody, good to see you. Thanks. We'll talk about the market a little bit and we'll go from there. Again, we've one of the things we'll just at the beginning, again, I'm Dan Sheridan. Mark Fenton here has been my cohort in crime for many years over at Sheridan Mentoring. And tomorrow we launch, we call it a 3K, plan to make 3K on 25K. We've been doing this class since June of last year. And overall, it's done well. And we've gone through the crazy markets, more quiet markets. But what's nice about it, folks, is it's an opportunity to go through a market in a given month with somebody. You know, we're going to be putting on live trades at just about every class we do. So we're kind of holding your hand, teaching you, but we're doing trades. You're seeing how we're doing it. I think it'd be a great opportunity. And, you know, again, great learning. You know, we haven't had this is about the 5th month mark that we've had a downtrend. I can't remember since Cleopatra came to Chicago. I don't think we've had a 5-month downtrend, you know, this, you know, in many years. Can you remember one? That lasted?
No, not a 5-monther. That's, you know, this market really since the end of 08 was really taken off for the most part. But boy, lately, it's some of the polish has been coming off.
Yeah. And so we'll talk, we won't go too long today. We'll talk about, but anyways, that 3K class, if you're interested, it starts tomorrow. It goes 4 weeks at, it'll be, we actually go 2 hours a day. We'll go at 12 Central. We have a boot camp. So people who are more beginner level, it gives you an hour of kind of build up the skill level. And then at 1 o'clock is the 3K class for those maybe who've been through the class a few times or maybe a little more advanced level. So you have the opportunity to get at least 2 hours, Tuesdays and Thursdays for 4 weeks. So you can go to Sheridan Mentoring and get information on the 3K class starting tomorrow. But as we look at the market, Mark, what stands out as we're going to start with SPX. As we look at SPX, what comes to your mind, Mark?
Well, as you said, we've had quite a downtrend, and we seem to have really broke down here the last week or so. Just red bar. The market just looks very weak. And there's a lot of talk, you know, you get below 4,000 here in the SPX. It's probably got another 100 or 2 to go. I mean, it's a very weak market, still tradable, but it is a very weak market. It shows you that, you know, you need to do the right things in this environment more than any, because this is the kind of environment you can get your head handed to you. But like you said, this is a time to have somebody there with you, because it's a more dangerous time in the market if you're doing things that aren't right for it, because this will bite you in a hurry when we have this much volatility.
Yeah, and it's focused on what's going in the market now, right? Mm-hmm. You know, we look at, you know, kind of a portfolio of options trades, maybe 3 kind of different, I'll call it boots, or 3 different pieces of pie. But the first piece of pie would be, let's call it, it'd be your smallest spec, right? And how many of you are doing spec trade where you're saying, hey, with the market movement, I'm betting on short-term direction and maybe using long calls or puts or long verticals, or some people in our community will use ratio back spreads. How many are doing, or based on charts, how many are doing some directional trades right now? How many are doing some directional trades right now? Anybody? Mark, I already know the answer, but I already know the answer. The answer would be yes from a lot of them, but they're slow. It shows that they're trying to eat lunch while they're doing the webinar. So they're not, there they go. Some of them have put down their sandwich and they're typing. So bear calls right now. They're different directional. So we would say anything where you have an opinion based on technicals, fundamentals, late night pizza, whatever, contrarian. Um, uh, that would be the spec part. And in the Sheridan community, and we'll talk about it in the 3K class next week, we may do some uh, speculative trades, and we try to keep the risk low. One strategy I know we'll be talking about in the 3K is we do directional butterflies, and that's a cheap way, right?
Oh yeah, that's a very cheap way.
Right. They're much cheaper risks than if you do a bear call or bull put or buy a call or buy a put. A much cheaper way to do a directional play. And we also do something with ratio back spreads, different strategies, but that's the spec part of the portfolio, and we'll be talking about that. The other part of the portfolio, again, we'll get into a few trades here, just trying to give you 30,000 feet up in the airplane, is range bound trades, where we look at market conditions. If we think we're in some type of range bound trades, and then we'll use the VIX or volatilities, which strategies to do. And who does those type of trades? Who does those type of trades? Any of you? That would be iron condor, butterflies of some version, calendars, double diagonals. Now, but here's the thing. As you're trading the market with range bound trades right now, are there opportunities? Yes, but just like if you're driving in, Mark, right, 15 inches of snow in Chicago,
Right.
And your wife says, hey, you know what, Mark, you need to go to the store. You need to go to the grocery store, Trader Joe's, get some stuff. Then you got to go over, pick me up these clothes, blah, blah, blah. So that's not a problem, as long as you're not taking the Optima, right, with no rear wheel drive, right? But if you got rear wheel drive, a big heavy truck, honey, lay it on me, right? I'll go to any stores. And I think with the market now, when you're looking at range bound trades, it's like, are there range bound trades that are okay now? Yeah, you just have to be, if you're in 10 inches or 14 inches of snow, you have to use your head a little bit. And as Mark showed with the red candles, who can look at those candles, right? Unless you're drinking tequila, excuse the expression, how do you get range bound out of the last week or so? Do you agree? Is there any justification for something range bound? Yes or no? No. And it doesn't mean that you have to have a perfect range but so during the 3K class, we will do range bound trades, but we'll pick our spots. We just don't, how many of you heard the expression, I don't want to catch a falling knife? How many of you heard that expression in the market? So it's picking your spots. And here's the other thing, Mark, out of the viewers that are listening, how many of these people, how many of the folk that are listening, do you think have much experience with the downside?
That's the big question right now.
Yeah, because I mean, for sure, I would go and say most of the people that are watching, they don't have much experience with the downside. You say, Dan, how do you know? Look at a chart of SPX over the last 5-6 years. Which way have we gone? Up, right? And some of the folk have some experience, but this is a great learning experience. It's not, you can't make money with range bound trades when the market's going up or down. It doesn't matter. You just need the candles to subside a little bit and get a little more range bound. Because if you look at the price chart there, Mark, if you look at like from December 22 to Feb 20, December, as you start moving to the right a little bit, like at the beginning of the year, we started that 10% correction down. And
Right.
then we kind of leveled off a little bit. You had a little bit of a range, and then it got, you got goofy. You get these 8, 9 days up, and then, and it comes down. So with the range bound, we're just going to be a little more careful how we do things. And then the last part of the portfolio is, so when people say, are you on the sidelines now? You have to break it down. Are you talking spec trades? Are you talking range bound? Or are you talking the last piece of the pie would be your long portfolio, where you would do like cash secured puts, covered rights, long diagonals, long stock, long mutual fund. How many of you are dipping your toes into trades that say, hey, I like Microsoft, or I like JP Morgan, or I like the market, or I like something, right? And I think it'll be higher over the next year. How many are you dipping your toes in the water with covered rights or cash secured puts or long stock or long ETFs? Yes or no? Some are, right?
Yeah, it's important to be long term. I see
Yeah,
my
long
Mike
term, but
just
that's
said
what we're
he's
talking.
long term.
Yeah,
Yeah.
but that's what we're talking about, long term view. And but the idea is, do you see that this is a craft, right? We're saying, okay, what do I want to do in the spec trades? Anything long term and then range bound. And that's what we'll be addressing in the 3K class starting next Tuesday. And for those of you who came late, you can go to Sheridan Mentoring. And I think that'll be a great opportunity to go through this a little more volatile, quite a bit more volatile market, as Mark and I will be doing live trades during this month. So you'll be learning a lot, as well as seeing how we're kind of trying to navigate through this. I think it'll be a good opportunity for you. So with this, let's start out with maybe looking at let's see, Mark, what trade do we want to start with for them today?
Well, you brought up the cash secured put idea. We can talk about more
Yeah, go
later.
ahead. Go on. Why don't you bring that up? We'll look.
Yeah.
So we'll
Now
look
this
at
isn't my opinion necessarily. Just wanted to show you an idea. So Barrick Gold, obviously it's a gold miner, and it's been beat up a little here lately, but it seems to have stabilized. You can see how far down it's come. There's a lot of bullish, sentiment for gold with inflation and that type of thing. And maybe you think, hey, you know what? I'm not really afraid of Barrick going much lower. Matter of fact, if it would get to 20, I would be a buyer. Well, if that was your sentiment, one way to play that is you could sell just a vertical. You could go out to September and maybe sell the 20. And then I like with these, I know that a lot of people do cash secured puts without a long beneath them, but the long beneath them can be so cheap. And what it does is greatly lowers your margin. So you could put on 5 of these. So then if it was at 20 and it got put to you, you would be able to buy 500 shares of it if you wanted. Remember, this is if your sentiment is you're a buyer all day long at 20, which you can understand that. I mean, it's that's a pretty good base down there. Probably won't go much lower, but you can reduce that cost of the trade, the margin, just by putting a long underneath it. And I really like this in stocks. Say where you have a celebrity CEO, like maybe a Tesla. And so you do something in Tesla, and if anything happened negatively to Elon Musk, the Tesla could really dive. You might say, hey, I'd buy Tesla at this point, but it could take a dive beyond what you'd want. But with using a vertical, you protect yourself in case there is just a really aberrant move, and also lower the cost of the trade. So this is one of the things we do. And you can do this in whatever you have that has options traded in it, that you have this type of sentiment in. If you're willing to buy at a certain point, or maybe you just think, hey, we're not going to 20. I'm willing to put on a vertical. Well, there you go. You have this vertical, and you can make money just on pure time decay, which is always nice. And even if you did think I'll buy it at 20, well, even if you never got the opportunity because it never got there, guess what? You got some nice income from theta. So that's just one way to tackle a market like this, where many times when the market gets beat up to the level it is, there's something out there that you'll have an opinion on that, hey, this really got overdone. I don't think that it's going to go much longer. Maybe this is only down because the broader market is. I remember in '08, I felt that way about Exxon because I thought Exxon, it really just got beat up because the whole market drug it down. So I got long there at the end of it, '08, and it worked out very well. So this is a time on the spec side of things to look around. If there are opportunities, stocks or maybe even ETFs that you either would like to own or you just feel like aren't going to go much lower. They have maybe positive fundamentals in your mind or something, and you are more than willing to take a chance on them because you think they're underlying, they're just solid. They're not part of this, then maybe they're not a tech and tech's gotten beat up here. And you think, hey, they're only down because tech's got beat up or whatever your opinion is. This is just one way to do it.
Hey, Mark, real quick, let's just take a look. You brought up Tesla. Bring up Tesla just for laughs. Let's take a look at that. I just want to, just so we can. So if someone wanted to sell, this is an expensive stock, but why don't you just look at just look at sell put, right? No credit spread, just for a second. I just want to make a point.
Oh, yeah.
Let's say you're going to do a cash secured put. You're going to sell a put, around 30. Let's go about 30 days out.
How many?
You're going to sell a put about 30 days out.
Oh, 30. Okay.
So we're going to sell a put in Tesla because you say, hey, I love Tesla. I want to buy the stock. It's down $60 today. So let's say we sold a 20 delta put. So we'll go out of the money. And let's just talk about that a second. So a 20 delta put.
Maybe the 700 to 24.
Let's go to 700 put. So if we sell the 700 put, can everybody see that? It's trading at around $32. But the reality, that BP, I don't know, Mark, if you have that set in a certain way, if you're in reality, if you're going to sell a put in people's retirement account or a brokerage, it's not going to be they wish it would be 7,000. It's going to be, you've got to buy 100 shares of Tesla stock, right?
Right.
Which would be $108,000, right? In other words, if you sell that put in a it's not going to be, I'm not sure how Thinkorswim is picking up a margin of $7,300 there, because it's not, right? In a retirement account on a cash secured put, right, you have to put up enough to buy the stock if you're assigned. And in this instance, Tesla's
that number looks wrong, doesn't it?
It is. Yeah, yeah. It is. Yeah, it is. Does it? Oh,
I hit the wrong button. There we go. That looks
better. But it's still, even 25 would be wonderful, right? But it's
25,000. Yeah.
Yeah, because if you get assigned on Tesla, and Tesla's at $805, and if you get assigned on and have to buy it at 700, right? You're talking, or what is that? $70,000. It's a lot of money, right? So what we're saying is, hey, if I'm going to sell a put for $32, buy something against it. Buy a put at $10 against it, right? Buy something, right? Mm-hmm. You can buy it further down, but it's going to be, and again, if you're at your dinner table tonight, folks, just ask your wife, or if you're a lady in here, ask your husband and say, look, you got a choice. I can make $3,200. That's the 700 put on 70 or 80,000, or, right, I could buy a put at $11, right, against it, sell that put at 32, bringing in $2,100, but your margin on that, right, is going to be like $3,000, right?
Yeah, but it has 5,000 margin if you sold the 700 but bought the 650 just to protect yourself, you still take in $1,100.
Yeah, so we're going to talk, folks, more about this type of, I think, a more efficient way to do a covered right, more efficient way to do a cash secured put using options. That'll be a much better yield, a better risk profile on the downside, and this would be the long portfolio. Now, real quick, we'll go look at something that we like maybe on the range bound part of the portfolio right now, something we might be comfortable with. Mark, why don't you bring up an SPX? Just going a little quick because of time, maybe a butterfly. This is something with the volatilities higher that can absorb a ton of heat on the downside and is manageable on the upside. How many of you
About
have
30 days here?
Sure, sure. How many of you have ever done a butterfly for a range bound trade? Yes or no? How many of you would have done a butterfly? And again, it's not, again, it, the only time I think a butterfly gets really complicated or really hard to understand is if you've never tried one, right?
Right.
On paper. Just like riding a bike the day before you learn to ride a bike is hard too, right? Anyways, so Mark, why don't you maybe model one, go on in here and we'll take a look at one just to kind of give a feel of something that we may be addressing probably even in tomorrow's class.
Well, maybe let's show a balanced here. Maybe 70 up, 70 down, something like that.
You want to use 40, 15, where are we at? 40, almost 40, 15 or 40, 10? Maybe a little bit higher or leave it there.
40, you could go a little above, a little below.
How about 40, 40, 20?
All right.
Would you go just everything up 10?
That's what I'm doing.
Okay. So folks, this would be called a balanced butterfly in the calls. And maybe you widen it out. Those are 100 points difference between, But you can see there, folks, that this is a combination of a call vertical buying 140.90, and we're about 30 days out, June 10, and selling 140.20. So a 50 wide call vertical combined with a 50 wide call bear spread, right? But selling 140.20 and buying 139.50. So I'm sorry, let me, if I read this, maybe I said it wrong, folks, and I apologize. We're gonna do a bull call spread buying 139.50, selling 140.20. And then a bear call spread, sell 140.20 and buy 140.90. So you have that range where you make money, and it's pretty delta neutral trade. This would cost what, Mark? About
$620. About $620 is what it would be for one contract.
And why don't you talk, without getting a lot of into adjustment, just kind of say how we might, manage something like this.
Sure. I mean, a trade like this, obviously, we want it to have room to run around, which we do. And we're looking for that time to pass every day, maybe go for 10%. So 10% of this trade costs us, it's bouncing all over. With the mid price, maybe we paid $600. So we would want to try to get $60 maybe plus our fees. So as time passes, we build towards that. And this theta number gets bigger every day because theta increases every day. And if it gets out here on our margins, there's things we can do about it. First off, what's the scariest thing that could happen? Well, it could go down. And if it goes down, since we have these short deltas, you'll be down little or nothing. You might even be up a few dollars down here. So you have decisions to make. You could, what we call, adjust it, maybe add a graph to it. Maybe you just say, hey, I'll just take it off for a very small gain or, unlikely, but a tiny loss. But you were in it. And you don't have to have trouble sleeping at night down here with a big down move. And even on the upside, where you're down a little more when you get to the edge of the expiration graph, which is right here, you can still easily adjust it or make other decisions however you want to handle it. But the thing about this is we want time to pass. We don't want a lot of trouble. You're not going to get in a lot of trouble. Look at this trade. It's a trade that makes it difficult for you, if you're paying attention and know what you're doing, to really get killed, at least until, deep into the trade, if even then. By then, by the way, you should be out with your time decay. So this is the kind of thing that looks good even in a crazy market, because the chances you're taking are very small because the risk is so small the way this sets up.
Yeah, these would be, two types of trades. Iron condor and a butterfly that we would be talking about this week in the 3K class that'll be starting tomorrow. Again, You can go to SheridanMentoring.com, get a little more information on that. But these are trades that, like as I mentioned before, that we like when there's 10 or 15 inches of snow, right? That we think, it's like driving a big fat SUV with rear wheel, right? I don't care about 10 inches. And this is the type of trade that we're comfortable in a more volatile market. Now, again, we will talk about in class tomorrow some of the criteria we look at. We want to see, even in a snow, even in a, if you say there's 15 inches of snow this week in Chicago, there's going to be better times to drive than others, right? Once they clean up the street, Chicago's pretty good at that. Once they clean up the streets overnight, it's no problem. But, just like as Mark showed with the SPX graph, when we're going down, nothing but down for 3-4 days, don't be insane, right? We want to see a little bit of stability, right? So, folks, we want to invite you tomorrow. Join us in the 3K May class. It'll be a great opportunity to learn, put some live trades on. We've got basically we've got the first hour, we go 2 hours, Tuesdays and Thursdays for 4 weeks. The first hour boot camp will be for beginners. The second hour will be for more experienced, where we'll do adjustments and we'll do a trade for beginners and something for advanced. But I think it'll be a great opportunity for you. And we look forward to seeing you tomorrow. So, folks, have a wonderful day. Thanks, El Marco. And we'll see you guys tomorrow. If you want some information, you go to SheridanMentoring.com. Thank you, folks. Thanks.
Thanks, everybody.